Schedule 1 Other Income is a catch-all bucket on Form 1040. On the EA exam, the trick is usually two things. Is it taxable, and where does it land? In this lesson, we'll hit the common landmines: hobby income, lawsuit awards, prizes, scholarships, Coverdell ESAs, and a few weird miscellaneous items you'll actually see on test day. Start with hobbies. Hobby income is taxable, and it goes on Schedule 1 as other income. The big post-TCJA rule: hobby expenses are not deductible. But cost of goods sold is still allowed, because COGS reduces gross receipts to get gross income. Exam tip: hobby income is also not subject to self-employment tax. Lawsuit money is all about the origin of the claim. If it replaces wages or profits, it's taxable. Interest on a settlement is taxable. Compensatory damages for personal physical injury or physical sickness are excluded from income. But emotional distress is generally taxable unless it's from a physical injury or it's reimbursement for medical care for that distress. And punitive damages? Always taxable. The IRS has no sense of irony there. Prizes and awards are usually fully taxable on Schedule 1. If it's property, you include the fair market value. Two clean ways to avoid tax: reject the prize entirely, or have the payer transfer it directly to a charity so you never control the funds. On the exam, they'll tempt you with, "He donated it later." That's still taxable if you received it first. Scholarships are only tax-free if you're a degree candidate at an eligible school, and the money is used for qualified education expenses: tuition, required fees, and required books and equipment. Amounts for room and board are taxable. And if the scholarship is really payment for services, like teaching or research, that part is taxable wages, typically on a W-2. On the EA exam, required to work is your red flag. Coverdell ESAs are like education IRAs with strict limits. Total contributions for one beneficiary can't exceed $2,000 per year across all Coverdell accounts. Excess contributions trigger a 6% excise tax each year until fixed. And the absurd part is the penalty is on the beneficiary, not the parent who overfunded it. Also, watch the age rules. Contribute before 18 and generally use by 30, unless special needs. Finally, a few common miscellaneous Schedule 1 items. Jury duty pay is taxable if you keep it. Alaska Permanent Fund dividends are taxable. Executor or personal representative fees are taxable to the person receiving them. And even non-cash freebies can be income, like a host gift for running a sales party, reported at fair market value. Exam tip: reimbursements for actual expenses like parking aren't income. Derek works full-time as a lifeguard. He's also a competitive surfer and has entered surfing competitions for 6 years with the intent to earn prize winnings. He spends significant time developing expertise, and he keeps good records of income and expenses. But he hasn't earned a profit yet. As his tax preparer, what would you advise? Hobby treatment, business on Schedule C, or something else? Think about it. The best answer is that Derek is likely engaging in a hobby. Hobby income is taxable, but hobby expenses aren't deductible under current rules, other than COGS if it applies. The tempting wrong answer is Schedule C business, because he keeps good records and acts professional. But 6 years with no profit strongly points to not engaged in for profit, which is the hobby bucket on the exam. Maya sued her employer and won damages for emotional distress from unlawful discrimination. The distress led to hospitalization. Total damages were $80,000, including $30,000 that reimbursed her medical care for the nervous breakdown. How much of the award is taxable? None of it? All of it? $50,000 or $30,000? Think about it. The taxable amount is $50,000. Emotional distress damages are generally taxable, but the portion that reimburses medical care for that emotional distress is excluded. So you take the $80,000 total and subtract the $30,000 medical reimbursement. The tempting wrong answer is $80,000 because people remember emotional distress is taxable, but they forget the medical care exception.